Hey guys, Joel Franklin, market analyst for YouTrading, and in today's video we're going to be taking a quick look at a trade idea that I'm monitoring at the moment. It is to do with the S&P 500. So I've got a chart here, CFDs that track actually the price of the S&P 500 future, the front month future. But anyway, it pretty much represents what's going on with the S&P 500, and as you can see, the S&P 500 is down about 1.75% today in early US trade on Thursday, the 22nd of December. As you can see, the Santa rally that so often does happen has not happened at all this month. Let me just put up a monthly chart and you can see that we're down 6.6%. Been a pretty ugly month. It was all really triggered just over a week ago with the very hawkish Fed triggering a break. We had been in this uptrend on hopes for a Fed pivot in wake of a string of downside inflation surprises, but the Fed, with their hawkish message, has pretty much sent us out of that upwards trend line, ensured that the S&P 500 wasn't able to break above its 200-day moving average or above this downtrend that's been in play all year. We broke also below a level which had turned into quite strong support just above 3,900. That area now pretty strong resistance. As you can see, we tried to rally back above that 50-day moving average yesterday, weren't able to do it. Everyone's still feeling quite pessimistic with the Fed still being very hawkish, talking about rates remaining higher for longer. And the reason we're down, another 1.7% today is we've had a string of strong US data, not upside inflation surprises, which is good. We're still optimistic that inflation's coming in the right direction, but consumer confidence reached an 8-month high, 108.3, well above expected 101. GDP data for Q3, the final estimate was just released and was much stronger than expected, 3.2%. So when you talk about a US recession in 2022, we were in a technical recession in the first half of the year because of statistical quirks, but that's pretty much gone now in wake of this data. And then you can see here the unemployment claims rose a little bit, but not as much as expected. So a string of strong data releases there. Sort of underpinning the notion that the US economy is strong enough to take a significant degree of tightening from the Fed, which is it underpins their confidence that they're doing the right thing, So that's keeping stocks on the back foot. And what I'm thinking is in the next couple of days, next couple of weeks, in fact, let's look at the calendar. You got PC price index data, which is coming out on Friday, which could underpin sentiment. If it comes in at 0.2 month over month, that is pretty much consistent with inflation running at the Fed's 2% target. So, there's scope for a little bit of a rally on inflation data, but other data next week there's nothing really. But in the early year, ISM manufacturing PMI, ISM services PMI, jobs data in the first week of January could all be quite strong. Maybe not in the manufacturing, but the services for sure. So if we do get any rallies back towards 3,900, back towards this 50-day moving average, I think they will continue to be sold, as has been the case. And I think an eventual test of support in this 3,700 area is likely. Now, am I calling for us to break out to fresh annual lows just yet? Unless there's reason for markets to continue revising higher their expectations as to where the Fed's terminal rate is going to be, which I don't think there will be because of inflation coming back under control. I don't see it happening. At the moment we're talking about the Fed interest rate going to about 5%. Or a little bit over. If we start talking about it going to 5.5% or closer to 6%, then for whatever reason, perhaps inflation surprises come back again, or, there's other things, there's just the labour market refuses to weaken, then we could potentially be headed back here. But I'm not betting on that just yet. I want to see how things go. And I'm actually still optimistic that if inflation continues to drop rapidly, and when the US economy does finally start to take a turn for the worse, which, there's already indications that it is, the rate cut discussion for the end of 2023/2024 can start to come back in, and things will be choppy. But as we go into 2023, this trend line gets lower and lower and lower. I think we can eventually break it, and the 200-day moving average gets lower and lower and lower. I think we can eventually break above this area. But anyway, that's a very long-term projection. So yeah, guys, hope you all enjoyed the video. Hope you all found it informative, and I'll see you all in the next one.